Well, there are a couple of standard questions that I would be asking any advisor. One, obviously, we've discussed before many times, is are you a fiduciary? Are you always going to work in my best interest? Do you work for me or do you work for a company? And when you make a decision, is it going to be based on is it better for me or is it better for you or is it better for the company? In our situation as a RIA, we have to do what's in your best interest. You have to ask your advisor, are you working for me or are you working for the corporation that you work for? And 9 times out of 10, they're working for the corporation. And although, of course, they're always going to act and try to do what's best for you, in the sense, it's already set up so that they work for the corporation. They don't necessarily work for you directly. We are 100% independent. That means we don't work for anybody else but the client. I'd say that's the very first question. The next question is what kind of training they've had. Obviously, are they a certified financial planner? Do they have a CFA? Those are all wonderful things, but how long experience does he have and what's he do with the money? Does he use his own research and then put together something for you? Or does he send it off to some program or plan that the company's put together that says it's good for you? Do they know who you are and why they're putting the plan together? Just because something's a good investment doesn't necessarily it's a good investment for you. That's really one of the most important questions that a lot of people miss, is that they think because an investment's good and it's done well over, say, the last 10, 20, 30 years, it might not necessarily be a fit for you. For example, I had at one time a client come in and he wanted me to day trade for him. By the way, he was pushing 80. So I don't know why he would want to do that, but somehow he got it in his head that he could take his almost $1 million and flip it and turn it into quite a bit more money by buying certain stocks in the morning, selling them in the afternoon. He had this whole theory as to how things were going to work. Now, mind you, that this would have made our company a lot of money in these trades because he was doing it based on just the trading part is how he was going to pay us at the time. Well, the fiduciary standard for me, and even though I was with another firm at the time and wasn't a fiduciary, it kicked in. And I said, look, this is too risky and too dangerous for you to be doing. And although other people might be doing it and it might work for them, you're almost 80 and this is the only money you have. Why would you put it all at risk when it can disappear overnight if you pick the wrong things? And he was adamant that he thought it would work for him. I was adamant and asked him to use somebody else because there was no way I was going to put him through that risk factor of what he was trying to do. So although the system worked well for other people, it definitely was not something he should be using.